All right. Good afternoon, everybody, and welcome to Tales from the Coach. I had a little problem. If you've ever inhaled a piece of a radish, they're real hard to get out. So I apologize for my tardiness. Hello, gentlemen. How's it going?
I was worried, Hogue. I just saw that message that you inhaled a radish. I was thinking like a whole radish and you were getting a
Uh,
Heimlich done or something.
Yeah, I was having a
no,
little trouble trying to picture what happened also. That's
it was just just a little piece of it, and boy, it burns. uh but thank you for checking up on me, and I think we're good to go now.
Awesome. Well, Hogue, we'll let you take it away from here. Me and JD are here to kind of moderate, answer any questions that are in the Q&A section or the chat over here. I probably have to leave about halfway through, Hogue, but we will be
Okay.
here. John will be here the whole time.
We'll take care of it. Thank you both for being here, and as always, thanks for all of you for attending. So we've been doing the group coaching for quite a while now. I think about 4 or 5 years, and there's certainly a pattern to some of the questions that get asked. So I thought I would do something like this, Tales from the Coach, and talk about really 10 of the biggest challenge that traders have, no matter what your experience level is in trading. We all have a lot of the same experiences and a lot of the same difficulties. So I thought I would put together this little 2-hour class and talk about it. Now, if you've been coming to group coaching, some of this might be a little bit redundant, but it never hurts to hear it again. If you're new to coaching, we do it every Monday and Wednesday at 1 p.m. Central. Anybody is welcome to join, and you can ask your questions. And if I know, I will answer them. Nobody knows everything. I certainly don't. This picture is of me and my son about 10 years ago at Dreams Park in Cooperstown. I was coaching his 13U baseball team at the time, and I just thought it would be a good picture. He's 6'4" now, so he towers over me. Just to do a brief introduction, if you don't know me, my name is John Hoagland. I'm the senior performance coach here at Topstep. I've got 39 years futures industry experience, more like 30 years as an active trader. Did trade on the floor of the Chicago Mercantile Exchange for 20 years. And I migrated to screen trading in 2009. I'd had a number of friends that had attempted to make this migration rather unsuccessfully. So I knew that I had some quite a task ahead of me. I took a year to kind of unlearn and relearn trading from pit to screen. Been trading on screen and now helping develop traders at Topstep since really about 2011, even before we were formally founded. It's been my pleasure to do so. I hope that I've made a difference in all of your lives in trading. And I look forward to continuing. Thought I'd introduce my coach. Here's my first coach. That's my dad, Richard H. Hoagland. Sometimes if you're watching the forecast or the recap, you can see a couple of his badges over my left shoulder, but he was a 45-year member of the Chicago Board of Trade. He was a very wise, very funny, and very caring man. Excuse me 1 second, folks. A little more radish. Sorry about that. Isn't he a handsome guy? He's my dad. He was a wonderful person, and I miss him very much. This is the CFTC disclaimer. It states that futures and forex trading contains substantial risk and is not for every investor. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. I look at risk capital as money that I can afford to lose. You should only be using risk capital, which is one of the reasons I love Topstep so much, is because you're not going to have to put up risk capital. You succeed in the trading combine, we're going to be putting the risk capital up for you. We're not going to be suggesting the purchase or sale of any futures product or securities during this session. There's going to be no trading here, so there's no representation ever that any account will or is likely to achieve profits or losses at all. Past performance is, of course, not necessarily indicative of future results. One of the first questions we're going to talk about is basically based on CFTC Rule 4.41. Hypothetical and simulated performance results have certain limitations. They're not actual trades. There's sometimes a difference in when you get filled in a simulated account versus a live account. Most importantly is the first question that we're going to be talking about today. The table of contents for day 1 and day 2. Today we're going to be, first subject is why is it so easy to trade sim and so hard to trade live? Then we're going to go into what is the opening range. I have a feeling that a lot of folks that come to the market forecast and the market recap, this might be their first introduction to the opening range. We're going to take a look at that. We're going to talk about the auction process. How can it help us in day trading? Because everything we're doing is basically part of a long time frame auction. A lot of folks don't know open interest when they start watching the forecast or the recap, where to find it, what it means. Delta is also something that people are introduced to when they come watch me or meet me. A lot of folks look at Delta in different ways as far as footprint charts and order flow, but we're going to take a look at how we can use it, what it means, and how to collect and organize the data, including open interest, delta, volume, all the different facets of the auction process. That's going to be all through today. Day 2 on Thursday at 12:30, we're going to talk about the glass ceiling. How many of you have gotten close to the profit target, and then you continually blow it once you start getting close to the profit target? And why is it so difficult to trade this? Why does it seem like nobody just has the knack right away? Why are we not wired to succeed at this? And we're going to talk a little bit about handling emotion and psychological issues. And finally, actually, one of the most popular questions is, how many markets should I trade at once? So, first question, why is it so easy to trade sim and so hard to trade live? Why is it so easy to trade sim and so hard to trade live? Why did I put that on there twice? I don't know, because probably this is one of the most popular questions. Adding risk to your trading plan. If you think about trading, the risks of trading, which are financial, in a physical risk, this might make a lot of sense to you. When you're trading in sim, you can kind of view it as a balance beam that is right on the floor, right along the floor. You can probably, if you're an able-bodied person, be able to just basically dance back and forth across this balance beam laying on the floor. Because why? There's little to no risk. If it was just a 2x4 laying on the floor, you could just kind of walk back and forth without really much care about falling off. There's no risk in it. You're not going to hurt yourself if you fall off this balance beam. Getting into the trading combine increases your risk. It also increases the accountabilities that you have to account for when you are actively trading in any account. Whether it's your account or our account, you'd better be keeping track of your accountabilities, your rules, your risk limits, your daily risk limits, your weekly risk limits, your trading size. All of these things are going to affect your performance in the trading combine. Most importantly is, it's not just a random sim account. There's a little bit of skin in the game. You have a goal. You want to get funded. That's going to add a little bit of duress and a little bit more skin in the game that's going to make it a little bit more difficult for you to just basically walk back and forth or dance back and forth across this balance beam, which is now 2 feet high. The one on the floor was real easy. It's going to change things a little bit because there is a greater amount of risk. If you were to fall off or turn your ankle, much bigger risk of injury. And remember, we're likening the injury in finance to physical injury in this explanation. So it's the same process going from this end to that end as it is going from this end to that end, but it's just going to feel a little bit different and a little bit more risky because you've got the height. Get into a funded account, real money, ours or yours. That raises the bar even a little bit more. Now we've got a real balance beam here, which is approximately, I think approximately about 4 feet off the floor. Successfully getting from end to end should be no different than successfully getting to end on this balance beam or this balance beam. However, it is going to feel a lot more different because if you fall off of this balance beam, the potential injury is going to be far greater. You have more skin in the game, the more you have in the game. You have a little skin in the game here with the combine, no skin in the game in sim. In a funded account or your own funded account, you're going to have that extra duress of the risk of injury, real injury, now that you're on the real balance beam. Always amazes me how they can just kind of dance back and forth and do flips and land on these things. I don't think I could go from one end to the other at this stage. I'm sure a lot of you are a little more able than I am, but not me. I'm going to stick to this one, but not trading. I'm going to trade this one. So that's usually my explanation when somebody comes and says, Hogue, coach, why is it so easy to trade in sim and so much harder to trade in the combine or in a real account? It's because of the actual risk of injury, whether it's physical or financial, changes the decision-making process. What you find very easy to make as far as decisions are concerned on this, you're going to find it much more difficult to make on this. You're just easily getting in and out of trades. They don't really matter. So it seems to be a lot easier. Excuse me, I apologize. That should be all for that now. But again, getting higher and higher and increasing your risk makes it much more difficult to make the difficult decisions that we all have to make as traders. All right. Now, what are we looking at? We're looking at the opening range. How do I trade it? Are there any rules around it? Okay. No. What is the opening range? The opening range is a leftover, really, from the trading pits. This was the S&P pit in 1987, just before the crash. Look at the liquidity here. All of the folks in the middle were trading their own money. On the outside were all the filling brokers, and all the filling brokers, before the bell would ring at 8:30, had orders in their hands that were due fills right on the open. Okay, so sometimes there was a lot of orders to be filled, sometimes not so much. When the bell rings, all of the brokers are trying to execute those orders that are due fills on the open. Again, if there's not a lot of orders to get filled, it may take 30 seconds to execute them and a small range of 3 ticks. If there's a lot of orders to be filled right on the open on a busier day, it may take 5 minutes and a price range of 4 points to get all the orders filled. Then once the opening would calm down, the exchange would actually poll all the brokers and say, you know, we're thinking about this being the opening range, you had to make sure that your executions were part of that opening range, or you'd have to cash adjust your customers. Once everybody agreed on the opening range, then it was released to the world that this was the opening range. Now, on screen, if there's somebody that has an execution that they want to make right on the open, they've got the ability just to click it in and use a strategy to feed in orders, manually put in orders. And I feel like 1 minute is long enough for anybody that wants to get an execution done on the open to get it done. There are those that think of the opening range as 30 seconds. There are those that look at the opening range as 3 minutes or 5 minutes. I prefer to look at the opening range in 1 minute. So on certain platforms, you're going to be able to see the opening range. This gold bar right here represents the opening range on one of the platforms that we use here. That's T4 platform, but not all of them have the ability to do that. So this is TS Trader, and we're looking at this 30-minute bar here, which we can see it's an up bar. What we're seeing here is there's a tool that you can use that will point out the first minute of trade. So how do we use it? Once the opening range has been established, again, I use 1 minute. As soon as the market trades outside the opening range, I have a stop in to go long above and a stop in to go short below. If the stop gets filled on the long above the opening range, we already have our stop in to stop us out if we take out the low of the opening range. In this case, the market opens, looks higher, comes back inside the opening range, and then continues to look higher. Why is the opening range so important, and how can we use it? Oh. Because sometimes the market is going to be in control by longer time frame traders right off the open, be they buyers or sellers. How are we going to be looking for the opportunity to take the opening range trade? Is there something that's going to tell us it's more or less likely? Sometimes yes, and sometimes no. The opening range, I believe, has a higher probability if the market opens outside of the previous day's range. The market has to be out of balance already. And in this case, you can see this is 1 day. This is the market opening outside of the previous day's range, and the opening range trade, at least initially, offers us the opportunity for a long. And if the opening range remains the low of the session for the rest of the day, it can create some wonderful opportunities, especially looking at this. Okay, this is the opening range. It's the opening range right here. And this market continues to push higher throughout the entire session. Think of the risk to reward you were able to accomplish if you bought the opening range on a day like this and got out basically on the close. You were able to catch that whole range. When the market is less likely to provide an opportunity for the opening range trade is when the market opens inside the previous day's range and value. On this day, well, this actually opens outside, so this is that day. But when the market opens inside the previous day's value area, there's very little change in the perception of value. Sometimes, of course, the opening range trade will be effective inside value, but I think it's a lower probability. Now, there's another factor that can affect the opening range. A lot of people look at it. A lot of short time frame traders are aware of it. How does that affect its performance? Well, the more people that do it, that look at it, the less likely it is to perform. So you're going to have a period of time. This is the S&Ps, and I've seen periods where The opening range is one extreme of the day session range, 8 out of 10 days. Those are wonderful periods of time, because if you're playing the opening range trade, you're getting handed cash right off the open. And then I've seen periods of time when the opening range trade is not fruitful for 20 days in a row. What happens is, the more people that recognize that the opening range trade is providing opportunity, the more people are going to jump into it. The more people that jump into it, the less likely that it is going to perform positively. Once it breaks, once the shorter time frame direct competitors of ours recognize, hey, it looks like the opening range trade's working again, let's all get into it, they're going to wreck it, and they're going to wreck it for a while. And then eventually they're going to abandon it, because they're going to say something like, the opening range trade doesn't work anymore. Well, it doesn't work or not work. Does it provide opportunity or doesn't it? Then they'll all abandon it, and they tend to abandon it en masse. And that's going to create the opportunity for the opening range trade to provide, or a higher probability for the opening range trade to begin to provide better opportunities. The problem is, we don't know when our direct competitors are going to abandon it, and we don't know when they're going to jump into it. So it's always a bit of a calculated risk. The smaller the opening range trade, the more likely I am to take it, because the risk is smaller. Some of the best trades I've taken have been opening range trades, just because the opening range was so small, and then I end up with this wonderful situation and this wonderful trade. So the opening range trade, first minute, there are those that look at 3 minutes, that some look at 5 minutes, some look at 30 seconds. I think consistency, of course, is always going to be the key. The auction process. How can it help in day trading? All right. Well, what we're looking at in any market, anything that can be bought or sold, is it's part of an auction process. Okay, we have an auction here that auctioned higher over time. Then it ran out of energy on the upside auction, and then a new auction to the downside ensues. If you recognize this is the S&Ps. This is only a few days ago. This was when we came off the highs, and we've traded all the way back down to this level, and now here we are back at 40. Now, this was the September contract, so it's going to look a little bit different, but here we are. So we're looking at the auction process in multiple time frames. It doesn't matter if this is a daily chart or a 5-minute chart. The opportunities to use the patterns of the technical analysis and recognition of the auction process happens in multiple time frames, almost infinite time frames. Okay, so the auctioning process, there's certain things you have to be thinking about when viewing the market as an auction. Price is just the advertising mechanism of the auction. Volume gauges the power of the auction process. Higher volume, more likely price is going to go in that direction. Time gauges acceptance of price, and excess is where price gets too expensive or too cheap, and the auction changes direction. Okay, this is a 30-minute chart. I can tell because it's one of mine, and I've got settlements set up right here. This auction moves to the downside. It doesn't draw new sellers. Sellers back off. It attracts buyers. Buyers move this market steadily higher until it gets too expensive, and buyers won't pay it anymore, and the sellers take over, and price moves back to the downside. Now, mind you, this could be a 1-minute chart. It could be a monthly chart. The auction process occurs in multiple time frames. Okay, another factor of the auction process is the open interest. We're going to talk about open interest here very shortly, but open interest is the total number of contracts outstanding. I buy one from you, I'm long one, you're short one, we've created a contract. Time frames. Auctions, again, happen in multiple time frames. You've got your fundamentals, which are certainly going to affect price. A lot of folks look at the auction process as price moving between supply on the highs and demand on the lows. Supply zone, we're a seller. Demand zone, we're a buyer. And then, of course, technical analysis. Traders are always looking to the past to predict the future. Motivation. Is it a new position or is it a liquidation? Is that liquidation profitable or is it a loss? Opinion. It's the difference of opinion that drives markets. Ego, fear, greed. Humans change markets and markets change humans. It's been said that markets are irrational. I disagree with that. I think markets are very rational. It's the humans that are irrational. So you're thinking about the auction process, you're thinking about your competitors and the position that they are in. Think about this. If you were at an auction, an art auction, and you wanted to buy this Leroy Neiman, okay, it's the Chicago Mercantile Exchange trading floor. The auctioneer is going to come out and he's going to say, this is a a Leroy Neiman. It's of the floor of the Chicago Mercantile Exchange. I know there's a lot of traders here that would love to get their hands on this today. And I think it's being initially priced very cheap. Well, look at the colors, look at the flags, look at the quote boards, look at the pits. You look into the pits, you can almost feel the energy and the stress in these trading pits. You want this painting. And we're going to start the bidding at $1,000. So everybody that's interested in purchasing this painting is wondering if anybody's going to bid $1,000 for it. And if I say, okay, the bidding has begun and nobody bids for it, what's the auctioneer going to have to do? He's going to have to advertise price lower. Do I hear 950? Do I hear 900 for this piece? Auctioneer probably didn't do a very good job of talking up the piece. Finally, somebody says, yeah, I'll pay 900 for it. The downside auction is now over. And an upside auction can ensue. Now that the base is put in, $900, all the other people that are thinking about taking this picture home start to get involved in the auction process. Somebody says, I'll take 950, 1,000, 1050, 1,100, 1,150. Now we've got price steadily moving higher because of volume and participation. A lot more people have started to bid on this piece because they've decided they want it. Now we're at 1,200, 1,250, 1,300, 1,350, 1,450. Somebody just jumped at $100, 1,500, 1,550, 1,600, 1,700. Now we've got competition involved. These people are now jumping over themselves trying to get this painting bought. That's volume. That's participation. As price continues to move higher and higher, fewer and fewer people are willing to bid for it. Now we're up at 2,000. We're up at 2,050. Do I hear 2,100? Do I hear 2,100? Don't forget, this is a one-of-a-kind piece, a Leroy Neiman. This is a beautiful picture. Okay, I'll pay 2,100. Okay, we're at 2,100. Do I hear any more? Do I hear 2,150? Now, the auction may just end right there. We had a good, robust auction, lots of participation and volume on the way up. What if somebody from the back, who wasn't even part of the initial auction, jumps price 23 to 2,300? I'll pay 2,300. the auctioneer in the back is going to point out the fact that there is a new bidder. We have a new bidder in the auction. He wasn't even working on this bid, and everybody's going to turn around and look at this guy and say, what the heck does he know that we don't know? Sometimes that fact that there is a new business, a new bidder in the auction process can reignite the auction process. Sometimes if you're looking at a day time frame range and all of a sudden price jumps outside the previous day time frame range, that's a new bidder in the marketplace. That is keeping the auction to the upside alive. You're going to have a few more people. I'll pay $2,250. I'll pay $2,300. I'll pay $2,350. I'll pay $2,400. Fewer and fewer people are going to bid for the piece. Till finally it gets up to $2,500, and the guy in the back takes the picture home. We went from 1,000 to 2,500 in a robust auction. If the guy in the back decided he didn't want it anymore and he announced to the room, all right, I'll sell this picture right now to anybody for $3,000. Do you think anybody's going to take it? Nah. He's going to have to advertise price lower until finally somebody picks it up, takes it off his feet. He's going to take a loss on it. He just paid the high tick. I've done that a whole bunch of times. I bet you have too. Reading about the auction process to me has always been about this book right here, Mind Over Markets, the market profile and the auction process. Stottlemyre on markets, Dalton, markets and profile. It says right here, profiting from the auction process. Learn what the markets really are. They are truly never-ending two-sided auction processes that occur in infinite time frames. Now, we've been talking about the auction process. What the heck is open interest? Where do I find it? Open interest is the number of outstanding contracts in any options or futures product. One new long buys from one new short. Both of these are creating those positions against each other. One long, one short equals one contract. Okay, if that old long liquidates that long against an old short who buys or covers that short, they dissolve one contract. Neither of them has an obligation. They're both flat. They created and liquidated or dissolved one contract. If an old short, somebody who's already short, buys one from somebody who is assuming a new short, the risk is transferred and no change to open interest occurs. And the same is true for an old short if they buy from an old long, from an old short, if they buy from a new short. Why is this so important? This was actually from one of the emails that people send in for group coaching. Okay. Volume and open interest. I suggest take a screenshot of this because it is just a real simple way to be thinking about the auction process when it comes to price, volume, open interest, and what it all means. If price continues to rise over time on higher volume and increasing open interest, that is a market that is likely to continue to rise. We've got a robust auction in volume. We have money coming into the long side by open interest. Okay, if price rises and open interest rises, that's an indication of new longs, money coming into the long side. And then you're looking at that as an indication of a market that's likely to continue in that direction. But as price continues to rise and volume begins to fall off and or open interest begins to fall off, This is a market that is weakening. The strong upside move may be priming for a change in direction. Doesn't mean it's going to drop. It could fall into consolidation. It could fall into a bull flag. There's lots of ways that the market can change. All this is doing is giving us a warning sign saying, okay, price continues to rise, but we're not seeing the good volume and the increasing in open interest, which is money coming in as it rises. Money is now coming out of the market as price continues to rise. This is a weakening market. This is a market that is likely primed for a change in direction. The same is the opposite for the downside auction. Price continues to fall on higher volume and open interest. It's likely to continue falling. But as price continues to fall and volume and open interest start to fall, remember, falling price on rising volume and open interest means robust auction to the downside, money continuing to come into the short side, more likely to continue in that direction. Price continues to fall on falling volume and falling open interest. Some of those sellers on the way down have started to cover those positions. And this is a market that may be telling us that the weakness may turn into upside strength at some time soon. So here's what I look at to get this information is this link right here. cmegroup.com/market data daily bulletin. I can put that in. I see JD's already put the volume and open interest cheat sheet on there. You can also look at the bulletin, which is right here. I'm going to put that into the chat. So there's a couple of different ways you can find that open interest. How do I collect that information? This is how I collect that information. This is just a spreadsheet. Okay, I've got the contract month. I think this is crude oil. Got the contract month, the date, volume, open interest, change in open interest, closing price, change in closing price, and then I have delta and value area direction. So I can see as price moves, how volume and open interest are affected. Okay, now this isn't a really good example, and there's a lot of time when collecting this information doesn't seem to make a lot of sense. What I want to introduce now is delta, and then I can show you how to tie this all together to use it. And it's, again, not a daily thing that you're going to be able to notice and use in your favor, but once you get it, you'll get it. In futures, delta counts the number of trades that occur on the offer. So any contract that is traded on the offer lifted using market orders is positive delta, minus the trades that occur on the bid, which is negative delta. So you can have positive delta if more contracts are being traded on the offer. You can have negative delta if more contracts are being traded on the bid. Positive delta may indicate that buyers are more aggressive, and negative delta may mean sellers are more aggressive. But if price is moving opposite the more aggressive side, who is more likely to be aggressive? Who is more likely to try and hide their activities? The longer time frame. The longer time frame we're talking about here is a delta divergence. So collecting and organizing the information. This is early in 2022. This is the gold contract. Okay. Now, we just had a rollover. We just moved to April. So there's a whole adjustment in open interest that occurs with rollovers, whether we're going to gain it or we're going to lose it. In this case, we lost it. What I want you to focus on here is the 4th of February. We're trading 1807.80. 1807.80. We start to see an increase in open interest. These are all green. These are positive daily open interests. As price continues to move higher against Delta, all of these red boxes here are telling us that the more aggressive traders on every day in this period of time were the sellers. More contracts traded on the bid. You would think the more aggressive traders would be able to push price in their direction. In this case, they were not. We see volume largely waffling, but the big difference is we're seeing price move higher on higher open interest. That means buyers, money's coming into the long side. And then we see a negative delta. This is a divergence. When we see this, it should tell you that I usually say that it means there's a snake in the wood pile. It means that the longer time frame may be present in the marketplace, and using bids and using ICE orders and using different techniques to accumulate longs and get the short time frame traders to short. This is the 4th, 1807. We see open interest increasing as price increases. Price continues to increase against Delta with open interest. Volume continues to waffle, but this is the more interesting part, is we have the open interest increasing. Increasing as price moves higher. We start at 1807. By the time we get to the bottom here, we're at 2043. More than a $200 move in gold in a short period of time. I am sure that there are going to be a lot of questions about this. And I'm looking forward to having you in group coaching Monday and Wednesday, 1 p.m. Central, to go over as many times as we need to how to look at this. Now, again, there's going to be periods of time when this is going to become relatively obvious. Doesn't make it any easier to trade, but when you see a divergence against price like this, you're going to say, who showed me this? And I know what it means. And maybe I can use this to my advantage as a day trader, because as a day trader, knowing that there's an accumulation of longer time frame has me thinking I'm on a daily basis going to look for opportunities to buy this market when it exhibits some kind of weakness. And I'm going to try and keep this, stay on the long side as much as I can to try and take advantage of this upside move. Okay, here's where this market ended up. Down here. Okay. All right. That's all I got for you today. Make sure you come back on Thursday, and we'll finish up the most popular questions. A lot of them are some really important ones. Why aren't we hardwired to succeed at this, and why does it make it so difficult for us? Where do I go? Let me show you. Group coaching. right here. Okay, that's the direct link to join, or to register for group coaching. When you get the link, that's going to be the link through the end of the year. So you can attend every Monday and Wednesday for group coaching. Ron, I'm glad. Jenner, excellent. You are welcome, Ron. Michael and Michael, thank you and thank you. JD, thanks for hanging with me.
Hey, all right. There weren't a whole lot of questions rolling into the chat, but I think we covered just about everything that did come through. If anybody has any last minute questions, I'd say now's the time to throw them in the chat.
And of course, if something comes to you later, something comes to you watching this later on, come to group coaching. We'll be, answering any questions we can. I don't pretend to know everything. Nobody does. So what I love about doing these is because I probably learn as much as you guys do. JD, you know what I'm saying?
Oh, absolutely. Thanks for doing this again, Hogue. Everybody loves it. Peter Sexton, will there be a recording? Yes, there will be. We'll make recordings of this available to everybody. So just sit tight. Maybe we'll have everything ready for you on Thursday after the last class is done.
All right. Thank you, everybody. We'll see you tomorrow for group coaching at 1 p.m. Central. And then again, Tales from the Coach on Thursday at 12:30. Trade well, everybody. Have a great day. Watch yourselves. Markets are treacherous today. Watch your risk. Keep your size small. We'll talk to you later. Blessings to you all.